liquidity is not a problem for ETFs. So it's the most liquid product on the market because unlike single stocks, those are closed-ended securities. ETFs are open-ended securities. What that means, there's another layer of liquidity beyond the liquidity that's on the market on the screen. In ETFs, if you want to buy, there's a higher demand, but not a lot of supply, so no one is willing to sell. The market makers have the ability to actually go to the issuer and create additional shares and bring that to market.
The Get Rich Slow Club podcast is a collaboration between Tash from Tash Invest and Ana from Perla. The Get Rich Slow Club acknowledges the traditional custodians of the land we record on. From coast to coast, across land, waters, and communities, we pay our respects to elders past, present, and emerging. Any advice is general and does not consider your financial situation, needs, or objectives, so consider whether it's appropriate for you.
Welcome to the Get Rich Slow Club podcast,
where we take you from beginner to confident investor,
where we can teach you everything you need to know about investing.
So come get rich slow with us. Welcome back. We've got Ibrahim Hussein on the show today from Computershare, and we've had him before talking about ETFs. So we're excited to kick it off. Before we do you have a money win or loss that you want to share with us today?
Yeah, of course I do. And I thank you. And I think last time when I was here, I gave you a fairly philosophical answer when you gave me that, when you asked that question. This time around, I'll try not to be as philosophical. When I look behind your background, Ana, there I see one of your wonderful books, Kids Ain't Cheap. And I think it's very relevant to my story. So my last born has just finished daycare in December.
Oh, congrats.
Thank you. And then as we know, daycares ain't cheap, right? And they're fairly expensive. That's a conversation for another day. But I was talking to my wife and I said, oh, actually, we might be able to save a bit of money from all the fees that we used to pay to the daycare providers. What are we going to do with this money? And my wife, true to form, she suggested a few shopping ideas. And I said, okay, why don't we maybe look at investing that in ETF? So I did my own kind of model to say, okay, whatever savings we might get out of that, if I invested in an ETF for my 5-year-old, how would that look like when she's 18? So I'm still kind of fiddling around in that. And I thought that's very apt, especially given you've written a book about that and we're in this podcast. And I think one of the things that my daughters, I have 3 daughters who are under the age of 9. So the concept of money at this stage is relatively new to them. I think the concept of money for them is Happy Meals, some of those game tokens, and when they lose their teeth, which it's been a while, quite a few in the last few years. So
the tooth fairy, yeah.
The tooth fairy, that has cost us a fair bit. So I think what I want to teach them, I often get asked when I go and do talks and when I talk to my mentees, is they ask me a question, what advice would you give your younger self? And I think the advice that I want to give to my kids as they get to the age where they'll start to understand the concept of money is really also aligned with the subject of this podcast, Get Rich Slow. I think I like the message behind your name. When you're investing in financial markets in particular, it's about the long game, right? It's about the ability to be patient and to stay disciplined. It's something that when we were younger, we kind of lacked that a little bit. So I'll be teaching my daughters to remain true to their objectives. And, especially when investing in financial markets, there are always going to be, fluctuations, short-term volatilities. And history has told us that the financial market, the stock markets have always, withstood those volatilities. So if you remain true to your principles, and certainly when I was younger, I did act on impulses when, those volatilities happen and you're trying to reduce your losses or the market kind of run away from you, but you're not really reducing your losses. You're locked in the losses effectively. That's what I kind of learned over time. And it's probably the lessons that I'll be teaching my kids, my daughters when they grow up. It's a bit more philosophical. I thought I was going to not be philosophical.
Yeah, I was about to say, you can be a philosophical person. That was like a quick money win with a more philosophical answer. I liked that.
Yeah.
What's yours, Ana?
Well, I was just, you just reminded me, and I guess this is a money win. My older child just finished also early childhood education and care. So we're going to save a lot of money in childcare costs. So that's also a bit of a win. But at graduation, all of the kids had like a quote and what they wanted to be when they grew up. Apparently my kid wants to look for dinosaur fossils. But the quote was so fantastic. It said, like, what do you want to be when you grow up? And one of the things my kid said was, I want to work so I can make money so I can buy things for people's. And I just thought that was so sweet. I had so many parents reach out to me who know I do the podcast and work in finance, and were like, "That is so sweet." And I'm like, I don't even know where that came from. Like, it's obviously he's picked up something from us, but those little money things. So back to what you were saying, and also just picking up from your parents in terms of how you think about finances, investing, what you can do for other people was just a nice, like, it just felt like a total little money win to hear my kids say that. Yeah.
It's a life win. All the life wins.
Yeah.
I think just a quick comment on your, I think you should take credit to the parent for raising a kid to think like that. So credit goes to the parent as well. So don't never undermine that.
Yeah, it's nice that it's not even like, because I want to buy toys, I want to buy stuff for myself, like buying for other people's. That's so awesome.
Yeah, I had to take a screen grab. I was like, bless. Oh, yeah. I felt really proud. Yeah. What about you, Tash?
I bought a new laptop the first week of January, but I've been waiting for gift cards to have the gift card bonus offers. So Coles had gift cards that were 20 times the Flybuys points. So I bought $2,500 of gift cards and ended up getting 25,000 velocity points from that, which is fun because I was going to buy the laptop anyway. And that's enough to fly from Melbourne to Perth and a little bit extra as well, which is fun. So free points for things I was going to buy anyway.
I know people always ask you, Tash, you first know what you're going to buy and then you go and find the gift cards, right? You don't do the opposite. Is that right?
No, because I wouldn't want to sit on the gift cards and like not actually buy something, or then feel like I have to buy something if I wasn't planning it already, or even just forgetting about them. That wouldn't be very fun either. So yeah, I always have a thing in mind that I want to buy, and then I'll wait for a gift card offer. So I've been waiting for a little while for these ones to come back around. There were so many at Woolworths, but not at Coles, and I wanted velocity points, not Qantas points. So yeah, it's a good way to stretch it out and not have the instant gratification either, because you've really got to wait and plan for the moment.
Absolutely. All right. Well, let's kick it off. Let's talk about ETFs. But before we do, we're just going to have a little bit of a refresher for people who are new to this. There's a thing called a share registry, and that's essentially where you work. So can you just give a little bit brief explanation of what a share registry is?
Yeah, so a share registry effectively is the function of share registry is to really keep records of all the shareholders for companies in the listed in the share market, as an example. So our core function is to make sure that legal ownership of shares is always current. As investors buy and sell shares, our core responsibility is to make sure that as that change of ownership goes from the buyer to the seller is kept up to date. So that's kind of the core function of what we do there. But then given we are the record keepers of all the shareholding, our function to our clients who are the issuers is to really kind of facilitate the engagement with their shareholders. So if you know a company wants to pay a dividend or distribution for ETFs for that matter, we would be facilitating that. If they want to communicate with their investors for any reason, we would do that. If a company wants to facilitate an AGM, we'll do the end-to-end process from sending the notice of meetings to all the way to facilitating the AGM on the day. If a company wants to do a corporate action, they want to raise capital, there's a merger, acquisitions, share buybacks, we would do that on behalf of the issuer. And our role is even more critical in ETFs, which is going to be a subject of our conversation today, because unlike listed companies where shareholders have the ability to have an AGM and speak directly to the issuers, ETFs are not companies, and therefore investors do not hold shares in the ETFs in which they own. And therefore, Computershare is effectively the only conduit between the investors and the issuer, so to speak.
And for context for anyone who's new to investing, your first question mark for a lot of people are, what is this? I know back in the day, you'd get letters in the mail from Computershare. So especially if you've invested in something like Vanguard, any of the Vanguard ETFs, chances are you've gotten an email or a letter in the mail from Computershare, and they are the ones keeping track of how many shares you hold, how many ETFs you hold, and so forth. So just a bit more context there.
Is it only for people who buy CHESS-sponsored shares or ETFs, then you go and register with the share registry? Is it some custodian brokers are registered with the share registry too, or not?
Yes. So 99.9% of all ETF holdings are CHESS sponsored, which is great. And I think I may have touched on this in the previous pod. Investors have the ability to register their positions under their own legal name, but also they can go through a custodian. So those are the two holdings that are typically done under the ETFs, and any shares that are registered in Australia. But also when it comes to access, so I think where you're coming from is the retail trading platform. So when investors invest through retail trading platforms, there are two models. There are models where they could appear under their own legal name, under their own CHESS-sponsored ID, or they could be sitting under a custodial omnibus umbrella position. In that case, what we'd see on the register is that CHESS-sponsored HIN of the custodian, and all the investors that have used that platform will be sitting under that, but we won't have visibility on that. What we'd see is that custodian's CHESS-sponsored ID, and for those investors that have invested under their own registered legal names, we would see their names on the register. And at the moment, the split in ETF registers on average is about 70% what we call name on register. So these are the beneficial owners, the legal owners, mum and dad, and everyone else, and about 30% is custodian.
So if you buy on something like Pearler, Selfwells, CommSec, NabTrade, you'll either get letters or hopefully emails if we've moved to more digital, and you'll go in and register. And then on the share registry, you can do things like decide if you want to use a dividend reinvestment plan, you can add your tax file number, you can update your details. So it's that external separate thing where you can see that you own everything, which is awesome.
And please, if you can, for any listeners that are listening to this podcast, give us your email address. We don't like sending paper communications, but for the environment, it's costly. Just give us the email address and we'll be communicating with you via email.
Awesome. So you've created this really cool ETFs Insight Report. Why did you decide to do that as the share registry? Why did you feel that was your place to create this really interesting report?
Yeah, I think this is one of Computershare's thought leadership strategy. When we looked at the ETF ecosystem a while ago, we realized that there is really a critical role that we can play in that ecosystem. For one main reason, we are the conduit between the investor and the issuer. But most importantly, we are actually very independent, right? So we actually do not represent the buy side or sell side, for lack of better words, right? So we thought we could be in a really great position to really kind of bring the buyers and sellers together by doing this sort of research to see what do investors want? What's the gap there? Given they don't really have the direct touch points with the product issuers and product distributors, what can we do to help their voice heard to the issuers? So last year we came up with our inaugural research paper, which was fairly kind of high level. It was at 30,000 feet, so to speak. And this year we did a deeper dive. And what we did that was very unique to, I think, most of the research done in ETFs in Australia is we brought in academic research as well, which hasn't been done before in Australia. And the reason we did that is the academia, just like us, are also independent. So we thought we wanted to bring another objective voice into our research to be able to really kind of do a deeper dive to see what are the gaps there, what are the opportunities for investors, and what are the opportunities for issuers. So our intention overall is to grow the size of the ETF market so that both issuers and investors can be better off. So by bringing in the academics, it was good. So we teamed up with three amazing academics. So shout out to them. So there's Dr. Shane Miller and Dr. Associate Professor Benny Lewis from University of New South Wales Business Schools, as well as Dr. Martha Clement from Adelaide Business Schools. So Marta and Benny are of European background, so we were able to actually kind of leverage off some of the experience in ETFs in other markets. And there's a lot of work that we're going to be doing in this space as well, just to uncover some of the learning that have been done in other markets in the Northern Hemisphere who've had a head start in the ETF space, and to be able to learn and make everyone better. So that's kind of is our modus operandi and the why we're doing this. And hopefully that will be well.
Yeah, I found something really interesting because I spoke at the event where you kind of launched this report, and there was people in the room, a lot of like ETF issuers, people from the ASX, I think, as well. And I found one of the interesting things was one of the findings you shared was that people want more information. Was that the right wording? They wanted more information about products or more education. And a lot of the people in the room were like, oh, but there's so much information. Like, what do you mean they want more information? There's like PDSs. You can go and read all this extra stuff about ETFs. So it's interesting seeing the disconnect between the consumers versus what the experts kind of thought people needed.
Well, in this report as well, what to expand on that was interesting that a lot of people, the people who invest in individual shares, feel as though there's not enough information for them to invest in ETFs. Is that correct? Did I read that correctly?
Yeah, spot on. And I think just maybe as a passing comment, I want to thank you both for supporting our event. So thank you, Tash, for actually being a part of our panel discussion, which received some really great feedback from the participants. And Ana, thank you for participating in our interview. So props to you guys. Thanks for your support. Yeah, look, I think that lack of information was interesting because I think, and we discussed in our panel, Tash, I thought it'd be the other way around. It'll be too much information. There's so much information out there where it's sometimes difficult to really know what you need to actually read. So the lack of information is also, I think, to me, the way I look at that is people don't know where to find this information. It's not that there are not information out there, but they don't know where to start. And when we look at our statistics, about 91% of the investors that we've surveyed, so we've surveyed 5,000, close to 5,000 investors, which is one of the largest surveys done out there in ETF space, which was a mixed bag of existing ETF investors, non-ETF investors. And the survey itself was non-incentivized. So we didn't pay anyone to participate because we wanted to get people who really wanted to provide feedback to do that. So it was fairly helpful for us to do that way. So what we found out is about 91% of the surveyed investors told us that they're either self-directed or using platforms. And less than 10% were using advisors. And about 35% of that, 91% are using platforms. So these are self-directed investors. They're all largely retail, and it's a very fragmented demographic because people source information in their own accord. There are some that will listen to guys like you. Some will just do their own independent research. So you don't know where they're getting information, and most of them don't know where to get that information. So there's a fair bit of work to be done there by people like you guys, issuers in particular, product distributors and others, to make sure that there's a lot of information. There's a lot of good information out there, which we are aware of, is to help these self-directed individuals find that information there, right? Outside of ETFs, people who haven't invested in ETFs have got no idea where to start. And when we surveyed, about 85% of non-ETF investors under the age of 25 say they're really looking to invest in ETFs. So there's a huge market opportunity there for issuers, educators, and others, ourselves, to be able to direct these people to a channel where all the informations are. So it's not so much this lack of information, is how do we direct people to where the information is at? Yeah.
I find it really interesting how there is so much information in certain aspects of it, but it's kind of all in silos. Like the brokers will usually talk about themselves and what they need to. I guess Pearl is trying to branch out into educating as well. And then there's the ETF providers who just talk about the specific ETFs, but it's hard to find information that crosses over all those things so you can actually bring it all together. And it's hard when advisors are so expensive. So only 9% of people use advisors. That's such a low number.
Yeah, and I think what we need to, and I think we need your help as well, people like you guys, is to really be able to loop all the feedback from people who listen to you, so that we can relay that information to issuers. I think one of the interviewees that we interviewed on camera said that if possible, it'll be good for investors to participate in product design. I thought that was a really powerful message, because if you look at all of the products on the market there, whether it's a mobile phone or car manufacturing or whatever, at some point, the end users actually were involved in designing these products. And what we see in ETFs is the ETF issuers would create a product on the market. They do their due diligence and amazing research and bring product to market. But investors don't find out until the product is already in the market. So there's probably an opportunity for issuers and investors to kind of work together in designing some of these products. And there is cases in the US, for example, where in some of the smart beta ETFs, some issuers have actually teamed up with tech-savvy investors, for example, say, okay, what's trending? What's up? What do you think is going to be trending for the next 10, 20 years? let's put our heads together and come up with a smart beta ETF that kind of takes advantage of these upcoming trends, etc. So there is an opportunity for that. The main question is, how do we do that? How do we do that in a market that's so fragmented? And also, we have to respect that when issuers come with a product, it's their IP. Sometimes there's some elements that they want to disclose to the market before they go to market. So the question is, how do we get to a point where we can, and it comes with maturity, hopefully in the next, as the product evolves. But how do we get to a point where we can put the buyer and the user together and say, hey, this is what we want. Can you kind of create a product? And in some places like Europe, you can get some, investors actually have some kind of order a product and get that off the shelf. So yeah, there's a fair bit to work there. And that's what we're trying to do, is trying to kind of bring those two parties together effectively. Yeah.
Can you quickly define what smart beta is?
Yeah. So traditionally for ETFs, they're kind of, index tracking. So they track an index and the performance is benchmarked with the index. So they are not really intended to really beat the market. They're passively kind of following an index. Smart beta ETF is kind of cross between a passive and active, where it has all the elements of passive ETFs where the fees are low and they're not actively managed, but the issuer has the ability to handpick, if you like, the constituents of that ETF rather than following a broad-based index, pick specific stocks that go under that basket, so that, the intention is to be able to outperform the index. So that's a key difference. So smart beta ETFs are normally they use factor-based. So the issuer will use this factor-based to handpick those stocks that make up that ETF. So what they intended to do is to kind of customize that ETF to follow a specific sector or trend, etc. So you can have a smart beta ETF that follows the technology, for example, in which case the issuer will use factors to select which tech stocks need to go under that index. And the intention that if that goes well, then, it will outperform the market. So
I have the element of active. Yeah, we usually refer like completely passive ones versus some active as well.
Yeah, correct. Yeah.
Anna, what was the most interesting stat or thing that jumped out at you?
Yeah, well, I think I mentioned it earlier. I was very interested. I think the stat was that of the people who didn't invest in ETFs, one of the reasonings given was because they didn't have enough information, or they found it so confusing.
That's so wild.
Right?
In our little bubble where we only talk about ETFs usually.
Yeah, but then it also made sense to me in some ways, because it seemed as though younger generations are more likely to invest in ETFs. And I wonder if this is a generational thing, right? I find that, a good 10 years ago, 20 years ago, there was less visibility, less information. There weren't ETFs. It wasn't readily available. Now, younger people who want to have more diversification, want to reduce their risk, have access to ETFs. But there may be investors who've been investing for a longer period of time who have invested in individual companies because that was more accessible. ETFs didn't really exist the way they do now. I wonder if, and this is just a hypothesis from looking at some of the research points. Do you have any insights on that? Am I totally way off, or does that make sense? Yeah,
you're right. I think it's a generational thing. So investors that have done well by investing in single stocks tend to be conservative in that sense, where they say, look, I don't know these things. So if I don't know it, I'm not going to invest in it. The younger generation, a lot more daring. And also, you have to bear in mind, we're talking younger generation, they probably have grown up with ETFs. So when they started investing, ETFs were in existence, where you have a certain demographic that ETF is still relatively new to them, unknown, and therefore they're a little bit reticent in investing in ETFs. But I think that also, so about 30%, I think, of single stock in ETF non-ETF investors say they prefer to remain doing their own stock picking effectively. And I think that to 30%. Me is about 30%, yeah. And that to me presents an opportunity for ETF issuers, because this segment, from the feedback they're telling us, the voice that we're not hearing through that feedback is that they're looking for smart beta ETFs. So if an issuer can find a way to manufacture smart beta ETFs that appeals to their appetite, he'll get that because because that's what they're saying. They're saying we don't want to invest in broad-based ETFs because we don't know much about it. But I like to do my own stock picking, and smart beta ETFs
we'll invest
may provide
in an Australian mining company ETF maybe, or an Australian bank's ETF.
Yeah, just 4 of them in my portfolio.
Yes.
Which is like high risk, right? So it comes back to that education piece, right?
Yeah, so just got to expand on that as well. And when you look at, we looked at the average ETF holding in terms of portfolio size. So the average ETF investor is 10 years younger than non-ETF investor, right? And about only 35% of ETF investors are over the age of 64. It's about 58 for non-ETFs, massive gap. So younger generation have picked up on it. And what I found out is they told us on average I have $100,000 in my portfolio, and only about 38%, say 40% is allocated to ETFs. So that itself, it's okay. But when you start connecting the dots based on the other feedback that we have received, so there's a home buyers kind of element that we've uncovered in our survey. So what that means, you could potentially make an assumption that the 60% that has not been invested in ETFs are probably invested in domestic stocks, right? And also, if you look beyond that, their superannuation largely, most likely, have invested in ETF stock, in domestic stocks as well. So the question is, are there overlaps? Some of those stocks in that 60% that's out of ETFs already representing that 40% they have. And we know these are self-directed investors. They're likely not doing a lot of free balancing of the portfolio, or even having a sneak peek at their super. So there's an opportunity for ETF issuers to really kind of maybe try to educate the ETF issuers in terms of kind of looking at that and kind of helping these already existing ETF investors in using the ETFs as the building blocks to build their model portfolios. So I saw that as an opportunity when I connect all the dots of lack of information, or and the fact is the home buyers pronounced there a little bit, and I stressed a little bit, and also the fact that there could be overlaps there. So there's an opportunity there for both investors and issuers to actually use ETFs as building blocks, and also for issuers to educate the investors. Just wanted to make that passing comment.
Yeah, when we think about home bias, because like we say, like the Australian market is less than 2% of the overall world, which is pretty crazy. But then we're investing, was it 31% of our stocks are generally allocated towards Australia using the stats from your report. What number should that be? Like, I know that's a hard question to answer, but is 30% too much, or is that okay? Do you have a general idea of what that should be?
That's a great question.
Without giving any advice, obviously. But
no, that's fine. I'm not going to do that for sure. So the 2%, the Australian market is very small, right? It's a small country. Our market is fairly small, so that's not a surprise. We are a very small player in the grand kind of global financial markets. That's fine. I think what we need to really bear in mind that we would never be able. There's no such a thing as a silver bullet or a specific target when it comes to home buyers. I mean, if you go around the world, there is always an element of home buyers. And I think ETF deserves a lot of credit for reducing that home buyers. If you go through the chance 20, 30 years ago, pre-ETFs, the home buyers was about 80%. So ETF has actually democratized that access to global securities and reduced that home buyer significantly. So a lot of credit needs to go to ETF. That may reduce, or it may not reduce. It may stay the same. We don't know. But the other factor that we need to bear in mind is that the Australian stocks are also very appealing to local investors as well, because Australia is one of the highest, if not the highest, dividend-paying countries in the developed world. And when you overlay that, with our franking credit sort of provisions, you can see why the Australian investors would prefer at times to invest in domestic, in domestic stocks. So that's to be expected because of those facts. But also there is a lot of provisions, or there are a lot of opportunities for investors to access non-Australian stock, and ETF provides that. So maybe that's also, you could tie that, go back to that lack of information as well, where if a lot of investors, especially young investors who are coming into ETFs, are aware of the options that are out there, they may be able to look at that as an option for them to get access to those international stocks. And really, the beauty of that is what ETFs provide is you can access all these stocks, whether it's in the US or Europe, domestically, and therefore you don't have to pay an international brokerage fees, and you don't have to deal with foreign tax regulation as well. Yeah, absolutely. So I think one of the points I wanted to pick on from your question is self-managed super funds. That requires a research of its own, because there's, at the moment there's estimated about $1 trillion of self-managed super funds invested out there, and a very small proportion of that, from what we can see on the register, has been invested in ETFs, which surprises me. When you look at the attributes of ETFs, you would expect the proportion of self-managed super funds to be higher. When I started looking at ETFs, which goes back nearly 20 years ago, when you look at the register at the beginning of when we started looking at the ETFs, it was top heavy with self-managed super funds. So the early adopters of ETFs were self-managed super funds. That investment super fund has continued to be the same, but has been usurped by other investor types. So the self-managed super fund have been investing in ETFs from our perspective at the same rate for the last 15 years or so. And I expected that to be a lot higher than what it is. That being said, the way self-managed super fund invest in ETFs is different. So sometimes they will invest on their own self-managed super fund trustee, which is fine, and we can see them on the register. Sometimes they may do that through a family trust and maybe go through a custodian. So there's a fair bit of work to be done just to look at the whole investor types and to see what's the proportion of self-managed super funds are in ETFs, and make a judgment at that point. But I have a hunch that still underrepresented, which is a bit of a surprise for me. So just wanted to make that as a passing comment. We didn't do that as part of our research because that requires a research of its own. But since you mentioned that, Tash, in your question, I wanted to pick on that.
Yeah, most, just from your general knowledge, is self-managed super funds, from what I hear online, people seem to use them to want to buy property. Is that what a lot of the holdings are, or is it actually like individual stocks? Yeah,
look, I think the obsession of brick and mortars for Australians is true, and that holds true for self-managed super funds. And there may be some benefits in using self-managed super funds to invest in mortars and bricks, and that happens. But putting my ETF hat on, I think there's a lot of opportunities without providing any direction or advice to anyone for self-managed super fund to look into ETFs as well. Because if you look at some of the key attributes of ETFs, where there's diversification, which kind of lowers your risk, you look at low fees, which is very important. You look at the broad range of actually exposure that ETFs offer. It could be a fairly, something worth looking at. So when you look at those attributes in isolation and what self-managed super funds are, you could almost kind of say, okay, we kind of expected to see more traffic. Why aren't we seeing it? But also, I think the question is, it's again, very fragmented segment, because you have Mr. and Mrs. Super Fund making their own investment decision, sometimes independently, sometimes with advice. So it's very fragmented. How do you address that and be able to promote ETFs? I think that's probably the biggest question there. But that is one for the future. So hopefully next time I'm back here, or maybe if you invite me back, I may be even in a position to talk about that.
Awesome. One of the stats that surprised me was that only 19% of women are investing in ETFs. Can you explain that one a little bit?
That surprised me. That really surprised me. And also, if you look at that 19, not just 19%, if you look under the hood, most of that 19% is from the age of 45 plus. But that could be a representation of who actually responded to the survey as well. So we need to be mindful of that. But I think women overall are underrepresented in financial markets. So in our research, we quoted a research by the World Economic Forum, who say that, by Deutsche Bank, DWS, who did the research and say that, look, if women invested at the same ratio as men, there'll be an additional $3 trillion in asset under management. And then the World Economic Forum paper goes further and say that actually when women invest, they tend to outperform men by 1.8 percentage points.
I like that stat.
So really, there's a lot of work to be done here to kind of bring more women into the fore. And I think, Tash, you did talk about it in the panel about why you think the reason are, women, they do take career breaks. The gender pay ratio is also an issue there. And in our research paper as well, Associate Professor Benny Luz, one of our contributors, actually did a research on this and to see why women are outperforming men. And they find actually men are a bit more bullish when it comes to trade. They trade a lot more regularly, and therefore, because they trade more regularly, they tend to underperform women. So there's a fair bit of work to be done by two of you and others in bringing that girl power into the conversation. And then I think that's something that we'll be looking at as well, just to see why. I mean, there's those reasons that you mentioned in our panel discussion, Tash, the career break issue situation as well as the gender pay. Those are critical. But what else is preventing women from jumping on ETFs? I'm not sure what you guys see. I'm assuming that most of your followers will be young females, like looking up to you. Do you get the same sense, or were you also surprised by this?
I'm surprised it's so little. I know it would be underrepresented, but I didn't know it would be by that much. My following is 40% male, 60% women. So it's still almost half and half, which is good. I also see stats from things like Perla where it's 50-50 almost, or 51-49, which is amazing. But yeah, it's definitely a lot of marketing is targeted towards women in terms of you should save and cut your dish sponge in half. And the investing world is still very finance bro-y in some ways. But yeah, because of the bubble I live in, I was a bit surprised that the number was that low overall.
Yeah, and then the other factor as well we see, especially when in a household situation where there's a lot of kind of multiply effect when you look at women taking career. So a woman takes a career to start a family, right? And as they nurture the baby and they look after the family affairs, they may defer all the investment decision to a man, to the husband, for example, or the partner. So that may be a factor as well, where in the household situation where there's a bit of a kind of whoever's looking after the household defers the investment decision to the other partner. So that may be a reason as well. But there's a lot more work that needs to be done, which is kind of reason why we're doing this, is to identify those gaps and be able to address them.
Do you want to talk at all, Anna? You're all good.
It's a topic that's near and dear to me when it comes to women in investing, and especially those who are our parents. So I can definitely see issues across this in many different ways. And I think a huge part of the research that you're doing and what Tash and I are trying to do is just make education more accessible for anyone, regardless of gender, regardless of socioeconomic status, regardless of marital status. But it is challenging because it just takes time. A lot of that stuff takes time. Education is the first piece, and then everything kind of follows through with that as well. So I think doing the research and understanding the gaps, and then so understanding the numbers, so the qualitative side, the quantitative side, and then the qualitative side is why are there gaps? And we now know it's 19%. How do we adjust that? What are the things that we need to do, both as individuals, as companies, as a society? So yes, a little bit off topic here, but it all ties in, right? Because it's how do we help more people get wealthy, right?
Absolutely, yeah. I've got 3 young daughters, so I'm also well vested in this. So once we find a solution, please let me know.
Yeah, we'll work on it together.
Yes.
Yeah, absolutely.
Are there any final interesting insights you want to share with us?
Yeah, look, I think one of the key things that we find out, I mean, when we look at ETFs, the ETFs have been doing really amazing in Australia, globally, in the last few years. And I think what has been kind of attributed to the success of ETFs were the key attributes of ETFs, so to speak. So ETFs provide diversification, provides, there's low fees, provides broad range of access to securities and all that. So in most of the research that we've seen previously is kind of boxing these 4 or 5 things that are key to the growth of ETFs. When we did our research, what we found out is a case of horses for courses. So when we kind of put them in demographics, age demographics, we found out actually different demographics valued certain aspects more than the others. So when you look at 25 to 35 years old, they told us in that order that they value long-term investing, and they told exactly why they're doing that, because they're looking to be able to save money in the long run so they can afford things like buying their own homes. The second reason was diversification. And the third one was passive income, because ETFs pay distributions and therefore they value that as a number 3 in that pecking order. And if you look at that, that makes sense. There's a housing crisis as an example that is happening there for the young folks. And also that passive income does supplement the cost of living pressures. When you go to over 64, the reasons are slightly different. But actually, if you look at the midpoint, so from 35 to 44, or actually 45 to 54. So these are young adults who are probably starting a family and all that. They tell us number 1 is diversification. So they're looking at that diversification as the number 1 reason. Second is long-term, because they're still looking to save money either for kids' education, etc. And then ease of trading, which makes sense because these are young adults who are professionals, they're time poor, they want to be able to trade fairly easily. When you go to over 65, number 1 reason, diversification, because they want to reduce their risk, which is understandable. Number 2 is ease of trading. And number 3 is fees.
I'm surprised that passive income isn't one of those. Like, I'm actually surprised. I thought that you'd be in retirement and you'd want extra passive income, but it's not even the top 3.
That was a surprise for us as well, because you think a lot of retirees are looking for distributions as a means of supplementing their retirement fund. But I think also if you look at the same token, it's kind of a sum zero game, because if you reduce your costs and if you don't have income, that may offset that. But they valued fees as the number 3 in importance. And none of these other demographics mentioned fees, which also is interesting because the research that was done by one of our partners, Dr. Marta, looked at what sort of investment is more elastic to fees, more sensitive to fees. And what she, in her research, said that, look, for long-term investors, fee is important. Short-term investment, not necessarily, especially for institutional investors, which is, we don't want to go too much into it. But then you see young folks that are investing for the long term, they don't really care much about fees, which, kind of goes against that conventional wisdom to some extent. But that, I think, to me was really a good insight from our research, because we were able to actually compartmentalize the demographics to see what's important for them, which we hopefully issuers who are listening to this will be able to take that on notice and be able to actually address the segments differently, because it's not one size fits all, right? Each investment. And also there's also nuances on personal level in terms of risk tolerance and investment horizon, investment objectives, and so on. But I think overall this should help issuers do that. The other aspect that surprised me from ETF investors that responded to a survey, about 15% told us that one of the pitfalls in them investing in ETFs is lack of liquidity. And my jaw almost dropped, because liquidity is not a problem for ETFs. So, and that to me, Tarika, ties it into that lack of understanding, because ETF, for listeners who are listening to this podcast, it's the most liquid product on the market, because unlike single stocks that are open, those are closed-ended securities. ETFs are open-ended securities. What that means, there's another layer of liquidity beyond the liquidity that's on the market on the screen. So for normal stocks, the shares on issue are set. For you to be able to buy, there has to be someone else willing to sell, right? In ETFs, if you want to buy, if there's a higher demand but not a lot of supply, so no one is willing to sell, the market makers who are contracted by issuers to do market making have the ability to actually go to the issuer and create additional shares, which happens on a daily basis. So they can create additional shares, which through Computershare, as an example, and bring that to market. So liquidity is not a problem for ETFs whatsoever. And the same applies for redemption as well. So if someone wants to sell, but no one wants to buy, there's a redemption process. The opposite of that happens. So if you want to buy and sell ETF at any given time, you can do that irrespective of the secondary market volume that you see on the screen. So that's something that surprised us, given it's 15% of respondents told us that, and it kind of lends itself to the fact that maybe that knowledge is not too prevalent out there. So just wanted to kind of call that out.
The liquidity, yes, such an important aspect that it seems as though more education around ETFs and how liquid they actually are needs to be put out there. Yeah.
If someone wants to come and find this report and read through the insights themselves, it's just called the 2024 Computershare ETF Insights. Can they just download that from your website?
100%. It's a public document, and thank you for pitching for it. You've done a better job than I could have. Yeah, absolutely. They can download that. They can contact me through LinkedIn. If anyone wants to have a chat, they can call Computershare. They can go to our website, computershare.com.au, and use the contact us to ask any questions, and that will filter through to myself and my team. So yeah.
Okay, awesome.
Amazing.
Thank you so much for joining us. Definitely a very interesting report to have a read through if you're curious, and definitely log on to Computershare if you've bought ETFs and you're not even sure what a share registry is. See if your ETFs are on there maybe, but thank you so much for joining us.
Thank you. Thanks so much for joining us. If you found this episode helpful, please rate us 5 stars, write a review, or share with a friend. If you're new to investing, make sure to listen to our first 10 episodes. Follow us at Get Rich Slow Club or Tash at Tash Invest or me at Ana Cristina.
This show was brought to you by Natasha Etchman, who is an authorized representative 1299881 of Guideway Financial Services, AFSL 420367, and Perla, who is an authorized representative 1281540 of Sanlam Private Wealth, AFSL 337927. Knowledge is power, especially when it comes to investing. So make sure you check out our financial services guides and read the product disclosure statement and target market determination for any investments you're considering. See our show notes for more info.